Hello, everyone, and welcome to today's webinar. My name is Connor Spencer, and today we're going to be discussing navigating tax season with confidence, some expert tips for the new financial year. Quick public service announcements. As always, we'll be sharing the slides and recording with all the attendees today. So it should arrive in your inboxes before close of business around 5 p.m. After the episode is downloaded, cut, edited, and uploaded. So good chance, well, it may be in your spam. So if you're not seeing it there, it's probably in your spam folder, just because it does contain a few links and attachments in the email. So sometimes it gets dropped in there. And for anyone who is interested, and if you're new to Lawpath, you want to understand a bit more about what we do, I'm just going to share in the web chat a few helpful links. So you can actually see there should be our YouTube page where you can watch video testimonials from existing clients, our previous webinars, and some additional content on specific types of documents. There's also a link there where you can actually meet our internal legal team and some of the hot topics we typically cover on the legal and accounting front. If you're actually an existing client of ours and would actually like to do a video testimonial yourself, just reach out to me directly. It's actually basically a bit of free marketing for yourself. If you're on our webinar yesterday with TikTok, it can actually just be kind of small bump you need to generate new clients to your business. So that's there in the webinar chat if you want to see more on that. If you'd also like a demo of the platform, whether you're visiting us for the first time or existing subscriber, type yes in the chat. And if you'd also, we're about to drop a new accounting and tax portal. So if you'd actually like early access to that with our tax plan offer today, please also type yes in the chat and we can reach out to you later after the webinar. But we'll go to the next slide then, Tim. So for those of you who are new to Lawpath, quick rundown, who are we, what are we about? So we're an Australian-based online digital, legal and tax advice platform. We've been operating for over 10 years now. We've actually assisted over 500,000 businesses. This little data point is incorrect. And we have saved, within that time frame, small business owners over $100 million in their legal and accounting fees. So we're very much tailor-made for startups. Often people are requesting that 6 to 12 month audit of their business, whether it's around their business structure, their existing contracts, their intellectual property, advice on employment and contractor law, especially a lot of those recently with changes that were made. But we also help clients who go through rounds of investing, clients who are selling or buying businesses. And it's probably in truth the least interesting aspect of your business. Feel free to comment if you think otherwise. But at the minimum, every business, regardless of their size and industry, needs legal and accounting services. Every business owner needs to tick that box on at least a quarterly or yearly basis to ensure they're compliant with changes in legislation or with fulfilling their tax obligations. So we're very much a one-stop shop for businesses in multiple different industries now. You're not too small for us. Obviously, you're not too small for ensuring you have a strong legal and accounting foundation for your business. Some examples of clients that I've got someone who's got a camel milk business in WA, a woman who works with the Australian Navy up in Darwin, someone who may be coming on soon who's a biotech company using AI to evaluate things at a molecular level. I went completely over my head, to be honest. And lots of other people who have businesses like cafes, trades, consultancy businesses, software development, e-com stores, couriers as well. The list goes on. We are joined today, drumroll please, for Tim Quinn. He is a qualified chartered accountant with 17 years of professional experience in tax and business advisory at all stages of the business life cycle, from startup to exit. He has extensive experience supporting entrepreneurial clients to meet their tax obligations and advising them on making the tax system work for best for them and best for their business. He has run tax divisions at a director level. Not in today's webinar, but I feel like give a bit of a shout out to Pradi as well as Tim, since you guys have been with us for about a good 5 months now. Some really phenomenal feedback from clients speaking to you guys and using those accounting and tax services. So needless to say, Tim, also you're extremely qualified And so if you are behind on your tax lodgements, or you've got to get that upcoming BAS lodgement prepared, and you're not happy in potentially with your current accountant and like it all done by Lawpath, Tim and Pradi will be your men. So we will actually have a tax compliance offer at the end of this webinar, so stick around for that. But today, Tim will be covering tax considerations for different types of new businesses, tax strategies for Australian startups, types of startup expenses that are immediately deductible, and we'll finish and sort of match and link to how Lawpath can help, and conclude with a Q&A session. That being said, Tim will be answering a few questions throughout the webinar, so please jot them into the Q&A chat. But we do have that dedicated time at the end to answer your questions. Cool. I guess that's more or less enough for me, other than I guess an initial question for you, Tim. We've just finished the financial year back in June, just finished Q1 for this financial year, and now on Q2. Why is it so essential to be maybe speaking to the accountants this time around?
Yeah, thanks, Connor. Yeah, appreciate it. And look, it's a bit of a cheeky topic, a bit of a cheeky title to this one, calling it tax season. It's always tax season, no matter what time of year it is. It's the best time to fix your tax is now. The reason why it's, I guess, especially prudent to start looking at your tax again now is we've just finished a financial year. It feels like it was just yesterday. It was a few months ago now. There are things that you can put in place that you need to do proactively to get the most out of your tax structures. Sometimes you can look backwards and do little manual journals and tricks here and there. Usually you need to start taking some proactive steps to put into place before next June. It'll come up quicker than you think. Other reason why it's always tax season for us is you might think, oh, my personal tax returns are due at the end of October. You come on board with a tax agent, we push that way back to next May, and you're not even paying that until next June. So you might think that there's some screamingly urgent tax deadlines coming up. Get yourself a tax agent, and we can take some time and think about how we do things before we have to push it into the ATO. So let's have a think about it. Connor's just briefly teased what we're going to be going through. I'm sure that no one wants to spend an hour or 50 minutes listening to me read off slides. So I'm going to go a little bit all over the place. We might dip in and out of some topics. Please feel free to use the question and answer focus to bring something up. If you want some more chats, or you think I'm talking crazy, please throw a question at us. And if it's a one that we think the whole classroom could participate in, we'll bring it up and we'll have a chat. So feel free to ask throughout. We are focused at startup businesses. That's not to say that these will not be effective for ongoing businesses too, but let's be frank, a lot of us are new to this. A lot of Lawpath clients, this might be their first time doing it, and we're here to really hold your hand through that. You've probably already set up your business. You may not have already. These structures are never put in place for forever. Nothing's set in stone. We can always look at a business structure post-registration and see that, look, maybe your plans have changed. Maybe you've taken off. Maybe it's fantastic that you're making heaps of money, but you might be paying more tax than you need to, and there's some things we can put in place. A lot of people will just incorporate with a very simple structure. The most basic one for a company is what we call a mum and dad Pty Limited, a company with two shareholders, one share held by mum, one by dad. Very, very simple, straightforward way to get going. Potentially, there are better ways, probably a little bit more complex ways, but we can put things like a holding company in place, or even a separate entity to hold intellectual property. Perhaps those shares aren't owned by yourself and your partner individually, or yourself individually. Perhaps they're owned by a family trust. Anyone that has seen me do these webinars before will know how much I love family trusts, and how I think they're the best thing since sliced bread. We call this structure of the holding company and the operating company, and then all of it owned by this family trust. We really call it the gold standard. It is incredibly tax effective, and it's also fantastic at protecting your assets. So the time to start looking in terms of a good outcome in 2025 is now, because we can put these structures in place before 30 June. What does this gold standard look like? As I said, it's the holding company at the top that owns your actual business, your operating company that's doing stuff down the bottom, with that holding company potentially held at the top by a family trust. When we say it's scalable for investment, what we mean is it's easy to get investors in at the holding company level. You don't have to then, you might have 5 different business operations underneath. You don't have to sell them 5 sets of shares. You can just sell them one. So it's a great way to get money into your business at a low level of complexity. When we talk about de-risking, the lawyers love to tell you this, and it's because it's true. Anytime you separate out the legal ownership of your assets and your legal exposure to liabilities, your legal risk, anytime you're separating that with corporate structures, you're making it that bit harder for the risk, the bad bits, to infect the assets, the good bits. It's a fact of life that in business, lawsuits happen through no fault of your own often. And really protecting your assets from those sorts of lawsuits is a fantastic reason to get these sort of structures in place. We can consolidate for tax purposes just to make things easier. It's not like every new company you add to your structure doubles or triples your complexity. It's a little bit of extra work, but it doesn't have to be a lot. It's very, very easy to add those new operating companies, and it's very easy to remove them. You can potentially spin one off. If you're not interested in doing a certain thing anymore, you can sell that company out of your structure. Why do we like to have the family trust up the top? Family trusts are incredibly tax effective. The family trust is the only really legal way in Australia to split your income. Where a family trust is the ultimate owner of a series of operating companies or a holding company, whatever it may be, anything that's generating income, even passive assets like investments on the stock exchange, anytime that's owned by a family trust, you wear 2 hats. You might wear one hat where you're the beneficiary and you get some income. The most powerful hat is the trustee hat. The trustee is the person or the company that operates the family trust, and it gets to decide who gets the money, who gets the income from that trust, or ultimately the assets of that trust. Why that is so powerful and important is that not everyone in your extended family group will be earning the same level of income outside of this family trust structure. You might have one person on a very high salary. Congratulations, good for you, but you're not very helpful from a tax perspective. If I have $100,000 of profit sitting in my family trust, I'm not going to give it to you because you're going to pay 47% of that to the ATO. You might have a non-working partner. We might have adult children who you're supporting, or even adult post-working age parents that you're supporting. These people are fantastic, not just because we love and adore them and they're part of our family, but because, more excitingly for me, they're great tax buckets. These people that have low or no incomes can absorb all the beautiful profits of my family trust and pay very little tax. As you'll know, most Australians working age Australians will benefit from a $20,000 tax-free threshold, which means the first 20,000 of that hypothetical Quinn family trust, I can give to someone the first $20,000 and they'll pay no tax on it at all. So it's an incredibly, incredibly powerful tax vehicle. There are complexities to doing it, but once you start generating some real profits in your family business, it's time to start thinking family trusts. They are, of course, another layer of asset protection as well, which can come in handy. That there are certain family trusts that you can use in family planning matters, particularly if your adult children are getting married to some people you think are a bit not the best. You can put things in place there. Asset protection powers of family trusts are absolutely fantastic. They are a great vehicle to build your family wealth and intergenerationally as well. We can't talk about trusts all day. That's a subject for another webinar. Setting up your share capital, super boring, not very exciting, won't go into it at depth. Most people, like I said, will set up a company, 1 share, $1. That's fine for most people's purposes. Don't let this slide scare you too much. But if you are looking to get investment in capital, then we don't want to only have the ability to issue 1 new share, because then that new shareholder would own 33% of the company. For that reason, we do recommend, if you're looking to attract external capital, have a much higher number of shares for a much lower issue price. That gives us flexibility. We can issue new shares and it's not going to take up 33% of the company. It can be a much smaller bit. If you've already set your company up, one share, $1, do not fret. It's reasonably straightforward to do what's called a share split, and there are no tax implications of doing that. So don't be frightened. Just get someone to help you out with that. Not too exciting though. Cap tables, startups amongst us will be sick to death of talking about cap tables and dealing with Excel spreadsheets that have broken links, trying to calculate these things. It is a little bit more complex. When you get to this level of talking about funding raises, people will know what these things are, Series A, Series B, mezzanine rounds, things like that. It all gets a bit complicated, but what it basically means is your cap table is a way of capturing in one document who owns what in terms of your shares, who's entitled to own what in the future. You might have options. And for those of you that don't know, an option is a right to buy a share at a certain price in the future. You might have debt instruments that can convert to equity. It gets, you can really get down the rabbit hole. It's worth just bearing in mind, set it up early, trying to capture all of your different debt and equity instruments, so equity being shares. Down the track, once you've issued all the paperwork, it's very, very tricky. Make sure you get some legal support, some accounting support, get it up front, and get everything documented, because the first thing that new investors will want to see is they'll want to see your cap table. So if you have to flounder around and start building it up when they ask you, it's probably a little bit too late. So keep those records. Basically, this is why you don't do it alone. When it comes to capital fundraising, you always get accountants and lawyers that have done it before. They've seen all the horror stories and they don't want you to become one of them. Getting things signed, even some of these ASIC things are still wet ink signature. Literally, they will not countenance a digital signature. Getting everything signed, getting it stored somewhere safely with your accountant or your lawyer is super important. There's resolutions to take care of. There's agreements. There's everything. I mean, I remember when they used to send them out hardback. I'm showing my age now. These folders were very, very thick. There's a lot to do. Get someone to hold your hand and show you what to do. But don't forget, ESIC. This is a really juicy little one. It's really still not very well known about, which always surprises me. Probably because it doesn't help the day one founders. If you go in and set up a company from day one, and you want to use this ESIC, too bad. It's for the next people coming in. ESIC is an early stage innovation company tax offset. We like tax offsets more than we like deductions. An offset is literally money back into your money off your tax, rather than just reducing sort of your income in that way. So it's incredibly powerful. If you do qualify as being an innovative company, and there are a number of ways to do this, linked to, there's a points test where if you've been through an accelerator program, or if you have a research and development claim, things like that, you can qualify. You can also reach out to an accountant like myself who can go through a principles test, and we can see if you meet the qualification criteria then. But it's common sense. Is your company innovative? Does it have the ability to scale and grow quickly? If so, you'll qualify. This 20% offset literally means that if someone was to put in, say, $100,000 and invest in your company, they will receive a tax offset of $20,000. Now, if they were otherwise paying $20,000 of tax that year, that will be reduced down to zero. So it's an incredibly powerful one. Even more than that, you've had this wonderful offset up front. Thank you very much, Australian government. Your company that you've invested in then blows up, becomes huge. You'd think, oh, I've got a big capital gains tax to bill to pay when I sell this company. No, you hold it between 12 months and 10 years. The capital gain is completely wiped. So this is a huge tax saving. Of course, it's risky, as investing in startups is. Now, I'm just going to very quickly pause just to check the chat. I can see in the Q&A screen there's nothing coming through. I don't think we've had any chats either. We've had something from Carl saying, who is best to be the trustee of the family trust? Very good question. I prefer to have what's called a corporate trustee. So the trustee of the trust is actually another company. Why do you do that? You might say, again, asset protection purposes. You're really separating the trustee, who's the legal owner of the stuff, further from the beneficiaries who actually get the benefit, and from yourself as a trustee as well. So having this corporate trustee where you yourself are a director of the trustee company, that's the best way forward. And Suresh, and apologies if I've mispronounced that, has asked, what are the benefits of founder shares? Difference between ordinary shares and founder shares? Look, founder shares, you hear it talked about more in the United States and in other companies, in other countries. Typically, founder shares are ordinary shares. In a shareholders agreement, you then may give additional rights to those founders and those holders of particular holders of ordinary shares. Normally, the shares themselves work roughly the same way, but the founder element might give you ongoing board participation, ongoing board voting rights beyond that you would normally have as an ordinary shareholder. Typically, it won't give you additional protections in terms of a higher right to dividend or a higher right to capital or anything like that. That would be unusual. Thanks, Suresh. Good question. We might go swiftly on. How are we going for time? Not too bad. R&D. This is an area I worked in for a number of years. It's juicy, it's meaty, it's expensive for the federal government, and I'll tell you what, they have just started the most amazing transparency measure, where anyone who gets an R&D tax incentive, they will publish your ACN, your company number, your company name, and the amount that you said that you claimed on R&D. We might come to that in a second as to why they've done that. It's a very unusual measure for the Australian government. What is the R&D tax incentive? For eligible companies, and I emphasize eligible, it is difficult to qualify for, or it should be probably more difficult to qualify for. Eligible companies who are doing real cutting edge R&D, research and development, can get a tax offset for up to 43.5% of their eligible costs. This is for smaller companies under 20 million. That will be refundable. So if you imagine, like most early stage startups who are investing in a new, crazy, cool, innovative product, spending the money, probably not ready to sell it yet. If you imagine a company that has spent in year one $1 million on their R&D efforts, let's just assume all of that is eligible for this scheme, that company could receive a cash refund of $435,000. And you can imagine the cumulative effects of this over the years. In year two, well, thank you very much. I've now got another $435,000, which I'm going to spend on R&D, funnily enough. So this injection of cash just can keep on rolling while you're building and building something. In terms of what are the activities that are relevant here, it's basically trying to do something that you don't know the outcome. It's taking a chance. It's going out and saying, I'm going to build this really, really cool thing that has really great applications that no one else has done, and I don't know if it's going to work. If me as a competent professional in this area knows what's going to happen as a result of this experimentation, the government doesn't want to know you. They don't want to fund you. But if it's something that I think that this is going to work and this is what I'm aiming to do, and it's going to cost me a lot of money to build and test, fantastic. Then you can hit qualification. Please don't go down the path of trying to do this and spending all the money before talking to a professional that understands if you qualify. It is definitely worth getting an assessment up front. And we've just had another question pop in, just while I move on from R&D. How old do the children need to be for trust income so you can allocate to them for tax purposes? It used to be from the day you were born. And all of these newborn bubs were getting these huge trust distributions and paying very little tax. The government clamped down on that. It's now, I think, $416 off the top of my head that you can give to them tax free, and beyond that, you start getting taxed at prohibitive rates. So it's why the first question I always ask when I'm doing tax planning, particularly with clients sort of in the older middle ages, is I always ask them to remind me how old the kids are and who's about to finish the HSC, because then we start to be more useful. Carl's quickly jumped in with another one. Mum and dad trading company, my favorite companies. The shares are owned by the family trust, and dad's the only director. If the family trust has a corporate trustee, who's the best to be the director? I typically would see both. I typically see both mum and dad as being the two directors of that trustee company, or it could be just dad, or it could be just mum. There's no difference from a tax perspective. It's a matter of who signs the documents. Thank you, Carl. ESOPs. These are well, we call them in Australia ESS, at least in our legislation, or an ESOP. They are the same thing. If you hear them referred to either way, we can be talking about options, or we can be talking about shares. An option, again, being a right to buy a share. Whichever way you think about it, the aim is the same between the two of them. The aim is to get your staff on board, to get them aligned with yourself as a founder and as a shareholder. Let them become shareholders. It's the most obvious thing when you say it out loud, that when is your employee most aligned with you? When they benefit from your company's success. When they become a shareholder, they have rights to dividends. They have rights to the capital growth of your company. They are very well aligned then to your objectives of making the thing work. In startup land, it's often a way of saving cash as well. You want to get the best people. You can't afford to do it all in cash. You offer them a bit of equity. Now, you're already probably sitting there going, but I don't want to give away my company. The principle there is your share of the cake gets smaller, but the cake itself gets much bigger, in theory. Now, any well-designed employee share scheme will prevent bad actors that work for you from taking advantage. Typically, you'll eke out their allocation over a number of years, what's called vesting, if you've heard it referred to as that. You can put cliffs in place so they don't get anything for the first year. You can put hurdles in place that the company has to be a certain level of revenue generating or profit generating. You can tie it to their KPIs. You can do whatever you feel like, but within reason, pardon me. Those lawyers are probably listening to me and going to get me in trouble. Anything you can document that's reasonable, you can put into an ESOP. You do often see most startups will set aside, it says 8 to 10%. I often see up to even 15% set aside. That doesn't mean you're giving it away day one. It means that you've always got that expectation that in the future, certain key staff will have access to it. They don't have to be staff, by the way. They can be advisors, directors in your business, anyone who's contributing to your business. You can set that aside. There's a particular ESOP scheme from a tax perspective called the Startup Concession ESS. It's phenomenal. It is the best thing since sliced bread. If you're a company under 10 years and under certain revenue thresholds that most people will be fine with, you basically will be able to defer your taxing point, so you can get quite valuable shares and interests in shares and offer options to buy shares and not pay any tax on it basically until you make something from it. So the worst scenario would be, I guess, being taxed up front to get some shares that become worthless down the track. This discount scheme really avoids that, and you get very good tax treatment on the way out too. So if you are thinking about it, give us a call. We can talk you through that. And I'll just quickly see if there's any more questions. I believe Vanessa and Nick. Can you borrow funds from your trust to invest? You could. You probably wouldn't. I would think you would invest in directly from your trust, Vanessa, for the reason that the income from those investments is best treated within the trust. So I wouldn't be taking money out to invest. I'd be keeping it in. A trust can have a bank account. A trust can have a ComSec or a Westpac trading platform, anything like that. Nick, is there a way to defer tax on share awards via options? Yeah. Oh, if you're already over 10%, fantastic. You've mentioned a very, very good question there. The startup concession is only available to employees who get less than 10% ownership in the company. Once you're past that, you have to start looking a bit more creatively at different schemes. There is a way to defer tax. It's a really, really professionally enjoyable form of scheme that isn't actually an ESS scheme, but it's called the Loan Funded Share Plan. And Nick, if you'd like to reach out to me afterwards, I can talk you through it if it's ever interesting. It's where you will actually borrow money from your company on the provision that you must invest in shares at a current market price. There is no taxing point from that. You'll only be taxed if the share value increases and you eventually sell those shares and get a capital gain. So Nick, happy to talk in more detail about that in the future. We've got a question here. What percentage of annual income does a sole trade business pay as tax? We'll come to it in a little bit, but yeah, small businesses will pay 25% tax on their income. Small companies, pardon me. And then from Aaron, a family protection trust. Yeah, it's a lot of people trademark different trust deeds and give them certain flavors. And the protection trust is one I've heard of. When you say, is it a normal family trust? It is usually a discretionary trust, but the terms of the trust deed, which are the rules that govern that trust, will have a particular purpose in mind of asset protection, typically from new entrants to the family, which is a nice way of saying your son's or daughter's husband or wife. And very, very quickly, I don't want to get into too much detail, but given that Rodney is an old friend, I'll answer his question. Given that last year of business, you've made $100,000 in profit, can you leave it in the trust bank account after paying company tax until your children become 18? Rodney, I know I owe you an email. Let's catch up and talk in that in more detail. There are certainly ways of doing family trust structure, not only to give trust distributions in a tax effective way now, but to defer into the future. And turning 18 is a good deferral point. Yes, so you basically can do what we call parking profits in a corporate beneficiary and then getting them out in a tax effective way. So thank you for that teaser for everyone else, Rodney. We might move on. Small business tax concessions. I just got ahead of that question, didn't I? 25% for small businesses. Thank you very much. The big dogs are out there paying 30%, or should be. Many of them don't. Small businesses a reduced rate, and that came down gradually from 30% a few years back. Immediate deductions are fantastic. We used to be stuck in this ridiculous situation where the tax laws were designed that until you were actually working and generating revenue, your initial setup costs were held not to be deductible, or some were deductible as black hole expenditure over a number of years. Not anymore. You're paying your fees to get your company set up. You're paying your accountants and lawyers. Fantastic. It's deductible day one, as it always should have been. There are simplified depreciation rules too, whether you use them or not, because most people will ignore them and go straight to the immediate write-off rules. This became ridiculous during COVID, where basically every asset you bought was incredibly expensive. It doesn't matter how expensive it was at one point, you could get a deduction for it. No longer, it's been scaled back. But now anything you're buying, assets used in your business, where normally you would have to claim a deduction gradually over its lifetime, they now say, look, you're a small business, claim the deduction now. So we love that. Just as a word of caution for this financial year that we're currently in, 2025, it has not been passed as legislation. I cannot tell you why this keeps getting delayed. It's still in front of the Senate. I have a reasonable level of confidence it will be extended to 2025. We do just have a hand up there rather than a question. If you can just ask the question in the chat, I can get to it. I don't think I can do anything with a raised hand, but please ask the question in the chat. We'll be happy to address it. Just a little bit more detail. We'll probably skip over this. What are those setup costs? It's what you'd imagine. It's when you're talking to people about your business structures. It's getting things into place. It's when you're paying fees to talk to people about fundraising. It's anything involved in setting up your business, both the government charges that are directly incurred, but then also the advisor costs that you're getting off the back of it. Budgeting. Why are we talking about budgets? Aren't we supposed to be talking about tax? Has this slide stuck in accidentally? No, it's there for a reason. It's all part and parcel of the same thing. When we talk about tax, and we talk about what's coming up, tax planning for the year ahead, there is nothing worse from a client's perspective than receiving a love letter from your accountant saying, oh, by the way, make sure that tomorrow you'd pay that $50,000 bill to the ATO, and you haven't budgeted for it. You've got no idea. Your accountant sprung it on you. It might mean that business is good. It might mean your profit and loss looks healthy, but as you know, running small businesses, cash is king, and maybe the cash isn't there tomorrow to pay the ATO. So really, again, day one, go through your numbers. Can be back of an envelope, doesn't have to be the world's most complicated model, but do something. Have a strategy in place, work out how much you're going to need and when, how much you're going to be generating and when, and then push that back 6 months and then reduce it by 20%. Give yourself some artificial heart attacks. Give yourself some shocks to your business. Probably don't assume that another pandemic is coming, because that's pretty difficult to plan for. But short of that, think about how are you going to run this business, and be really unkind to yourself, because that unkindness and assuming the worst now, or at least being a bit conservative, will come in handy in the future. Your accountant must be telling you, as soon as you know what your business is going to make, they need to be telling you how much tax you're going to pay and when. It helps focus your thoughts as an accountant into, well, how are we going to reduce that? And if we can't, let's at least make sure we're paying it when we can afford it. There are things we can do with the ATO where we're dark wizards. We can whisper and sweet nothings to the ATO and really change your temper of when you pay tax. There's things like payment plans in place, payment arrangements. There are things we can do to wipe old debts, wipe interest. You might have heard people saying that the ATO are not the cuddly kittens that they once were. I'd say that's fair. They are clamping down on non-payment, but they at the same time love people who proactively engage through their tax agents. They love tax agents. I'd always thought of myself, when as a tax agent, being the agent of my clients. The tax agent thinks of me as an agent for them. They actually think that the best way to get people proactively engaged in their tax is having a tax agent that can be your advocate out there. And I agree. So do your research, do your budget, do it quick, run it past your accountant. I might not do a budget for you from scratch, because I don't know as much as you do about your business, but will probably know where you're being a bit too generous, or haven't thought things through. Run it past your accountant. Expansion. I love a scale up even more than I love a startup. Maybe things are going well. Maybe you want to explore new opportunities. Fantastic. You might be doing a new company, a new venture. Absolutely. You can spin things off. We can start things up. The benefits of this holding company structure, very simple to get moving onto a new thing. Look, when you're expanding, what are you going to have to think about, though? There's going to be some pain points. Maybe it's time to upgrade your accounting software. I will say Xero, MYOB, and QuickBooks these days are pretty good, up to a reasonable level of business. So don't feel like you need to jump into the next level. But again, don't make the decisions before you've run it past some trusted advisors, because there are things that we can do before you expand to really put structures in place to make it beneficial, particularly when you're going overseas. For anyone that's thinking of going to the United States, there are some steps that you should take before you do that. Perhaps your finance function as well needs a bit of a kick up the pants. Maybe it's time to get that external virtual CFO or fractional CFO you've always been thinking about. This is the finance function. That's what we're talking about. Your finance function can be you with your green build hat and your calculator. It can be you or your partner or someone that you know helping you out reconciling your accounting file in Xero or MYOB. Finance function can be very, very simple. It can grow. It can need to be more complicated. When you're hiring people, perhaps you want someone to help you process their payroll. If you've got a large volume of transactions, you don't want to be sitting there doing the accounting yourself. You want to be out there selling and building and making lots of money and paying an accountant to help you out on that front. It can get more complicated, particularly if you've got external shareholders. They probably want to have a little squiz at how things are going. They will probably want regular reporting. They will want regular tracking inside your accounting system. So you don't just do the typical small business thing of once a year getting your accountants to do a cleanup. They probably want it as close to live as possible. It's great, even though it's expensive, more expensive than doing it yourself. That additional visibility that you as a business owner will get over your business is helpful. You often don't know what you don't know. And perhaps you might think that the business is doing well when it's perhaps not as performing as well as you would think. This is always a painful one. For those of you that haven't had the absolute joy of being exposed to fringe benefits tax, fringe benefits tax is a real hurdle for small businesses. It means a fringe benefit is anything you give to an employee that isn't cash. You might think, oh, lots of businesses, you see it in the United States, do it. They'll pay for health insurance for their employees. You can think of anything that you can give to. You might give them a car. You might pay their rent. Please don't do that in Australia, at least without talking to your accountant. Fringe benefits are taxed higher than cash for most employees. So, and you'll have to pay additional complex advisory and compliance fees. So think carefully about giving a non-cash benefit. There are some exemptions. Look, we then get into the annoying side of having to pay tax on employment to a second government. It's not enough that we have to pay it to the ATO. You might have to pay payroll tax to your state government of choice or of residence, or perhaps multiple states if you're lucky enough to be operating in multiple ones. Everything just gets a bit more complicated. There's capital gains tax to think about. There are different reporting frequencies, loans, Division 7A. Too much to go into now. It gets more complicated the bigger you get. Just have someone on your side that can do all the boring stuff for you. Don't feel like you have to become a tax expert in all of these areas, because it's taken me 17 years and I'm not an expert in all of them yet either. I'll keep trying. Good time just for a quick question from another friend of mine, Warren. And he's putting his hand up. He's probably telling me to get a rush on. Is that true, Connor?
No, we're nearly at the end. That's all. So I'm jumping back in.
Fantastic. Thanks, Connor. Just quickly yes, my friend Warren. A parent company with a trading business, do you need to have potential new business options in there aligned to the same sectors? I'm not sure I quite understand the question, Warren. Sorry, I'm probably being a bit simple. What I would say is you can have companies in any industry and sectors that you feel like. There is nothing that says you can't have a holding company with 15 different operating trading companies underneath doing wildly different things. You'll see there are still even some very, very large listed companies in Australia with a very diversified direct portfolio of companies that do wildly different things. I used to audit one of them. I won't name drop them, but they had at the time 8 or 9 companies doing completely different things. They were doing them all very well, generating good returns for their shareholders doing it. But being diverse, you can actually diversify risk as well. And Rodney has just asked if he, as a director lending money into the company, what's a reasonable rate of interest? Well, most people do it the other way, Rodney. Most people borrow money from their business because they are themselves bootstrapped and needing to pay some bills. Lending money in. Look, the ATO publishes benchmark rates for lending money out, where you have to charge a certain minimum rate. It sort of tracks with the general interest rates out there for the banks. Couldn't tell you what it is off the top of my head. I think it's about 10%. It's roughly that. But yeah, certainly, if you want a benchmark rate, go out and see how much you would have to borrow. You'd be able to borrow from a bank at that same rate. That's probably a fair market rate. What would a bank charge? Then charge the same rate. And I think we had, no, that was it. Fantastic. We do still have more time for questions at the end. Is this one of yours, Connor? Would you like to talk about it? No, let's talk about it with me. I know best. This is our tax plan. This is our core compliance product. This is you getting your tax agent and us doing everything for you. You will receive a dedicated tax agent who well across your affairs, knows exactly what your business needs. They will meet with you day 1 or day 2, depending on your schedule. They'll work out what you need. They'll set up your lodgements with the ATO. They'll check, first of all, that everything's been hopefully handled by your old accountant if you've got one. There's no surprise missed lodgements or missed returns or unknown about payments. We'll make sure we sort that out for you. From then on, you're in our capable hands. We'll do your BAS. So your business activities statements where you're reporting your GST and your tax on employment, things like that. It's called PAYG withholding. we've got all that sorted, we'll do your annual financial statements. We'll give you a nice, pretty package that makes it clear that you know what you're doing. It's sort of required by the the Corporations Act. So we'll do that for you. We'll do your business tax return, probably the most important thing. All businesses must prepare an annual tax return in Australia. We've got it handled. And it's called a year-end consultation. It's really a year-end planning consultation. So it happens before the year end. Maybe not in October, might be too soon to start looking too closely at what June's going to look like to you. But as we get closer into March and April, we've probably got a reasonable sense of how your business is looking. Let's make the changes now that we need to reduce your tax bill. Don't start thinking about it in July or in August like some accountants do. You've got to get ahead of it. You've got to make the changes while you've still got time. We'll do it for you. Thank you very much. I'll leave you to read at your own leisure. BAS is due once a quarter for most companies, most businesses, I'd say. Most people, if you go it alone, you've got 28 days from the end of the quarter. Come on board with a tax agent, you get an extra little juicy holiday just to give us hardworking accountants a bit more time to sort through your stuff. What's coming up next? We'll leave that one to Connor.
So this is actually the next steps when you're on the tax plan. So it's also just that initial general assessment, just making sure you've got everything prepared for our accountants, ensuring no mislodgements, and obviously then we'll begin the hard work of actually preparing for you for the previous and upcoming lodgements. And relax, let us handle your tax compliance seamlessly. Go to the next slide, and we've actually got a breakdown of our standalones. However, you can bundle these different accounting plans together. And actually just looking at the poll, some of the poll answers as well, a lot of people have concerns around like GST, for example. So we can actually offer a lot of specialized advice tailored to your specific needs, whether you're uncertain about when to register for GST, you're debating on the pros and cons of registering at or before the threshold. If you're facing unique challenges like delayed income, we've got you covered there. So we offer both general advice, but we also have some case-specific advice, all backed by our seasoned experts, which also just help to make informed decisions that not only meet your accounting requirements, but also optimize your tax positions. People also had questions around the tax deduction. So tax planning or minimization, which is maybe a bit of a dirty word for some accountants. Obviously, it's what every business owner wants to know. So we cover everything from strategies for company tax reduction to reviewing your profit and loss statement for tax estimates. So whether you're a solo entrepreneur, you're looking for individual tax reduction strategies, or corporation aiming for more general, broad tax saving techniques, we've got you covered there. And then finally, on the sort of tax deductibles or tax concessions, we do also provide specialized advice on those, just to empower you to make smarter financial choices, whether it's just understanding what is tax deductible, for example, distinguishing between business and private expenses, or, for example, maximizing equipment or business motor vehicle tax deductions. And we cover a whole host of other topics on here, your business structuring advice, accounting software queries. So most people answer that they're using Xero or MyOb, or a lot of people also answer that they're actually not using any accounting software at the moment. So that's something our accountants can certainly help and guide you with. A lot of people need advice on issuing invoices, doing the monthly profit, viewing or running financial reports. But then we also provide advice on like PAYG, crypto tax, your super, reporting payroll, bookkeeping, and a whole host of other tax and accounting related questions, including Tim's favorite topic on trust. So we did do a webinar 2 weeks ago. It's on this topic. It's a highly popular topic for very good reasons. You can see even in this webinar, we immediately get a lot of questions on trusts. So our accounting advice plan, that gets you the unlimited consultations to ask us some questions on the topics I mentioned, but in particular, coming back to us for more info on maybe your existing trust, or if you're looking to get a trust set up with and by us, the accounting advice and tax plan will set you up for success for that. So if you're in the need for anyone to sort of take the wheel and improve the financial health of your business, we can absolutely help you with this. If you joined in later, Tim is the head of our Lawpath Tax and Advisory. So him and his team there can ensure your business tax is in safe hands, especially with the upcoming BAS lodgements and future lodgements. If you've invested probably in a business mentor for your business to get off the ground from an operational or marketing standpoint, invest in a competent and knowledgeable accountant will do the same for you when it comes to your tax compliance and tax minimization. So you can go to the next slide there, Tim. Just very briefly, so we have some bundle options as well, like a legal advice plan is extremely popular. It basically includes, in a nutshell, all our AI features, the 500 legal documents we have drafted by our commercial lawyers. Again, a limited consultations with our lawyers, limited on-call contract reviews with our lawyers, and they typically advise on, not limited to, but your business purchase and sale, establishing contracts you need for your business, for clients, partners, suppliers, and employees, intellectual property and trademarking, capital raising, as we mentioned here as well, they cover. Your ESOP, startup law, and commercial property law is also covered in the legal advice plan. And you can bundle it with the accounting and the tax as well for the highest upfront discount. And yeah, and we'll just go to the next one, Tim. So final piece from me before we answer a few more questions. We are rounding out for, I guess, Q1 this month with our discounted 30% off on our tax plan. So this, as Tim mentioned, is that dedicated tax agent service with that initial tax consultation. It's all that hands-on work from your annual to quarterly BAS statement and tax return, and the financial statements as well, which typically include your profit and loss, balance sheet, declarations, and notes to the financial statements as well. So if anyone would like to claim this, please type yes in the chat, or reach out to us directly for us to get you set up, including a product demo as well of the platform to get you started.